You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
And now, it's time for the show that breaks down the options market. From unusual activity alerts to market updates and trading strategies. If it involves puts and calls, then our all-star panel will break it down. It's time to hit the Option Block with your host, Mark Longo from theoptionsinsider.com, and co-hosts Mike Tusaw from KnowYourOptionsInc.com and Mark Sebastian from OptionPit.com. The Option Block is brought to you by Options Express. Don't spend time worrying about your broker. At Options Express, security, stability, and account protection are the most important responsibilities to our customers. Secure account access, enhanced financial protection, entrusted with over $7 billion in customer assets, established financial stability. Options Express lets you trade with confidence. Stocks, options, and futures, all in one account. Trade with a specialist. Visit optionsexpress.com/OXradio to open your free account. Options Express is a member of FINRA, SIPC, and NFA.
All right, everybody, welcome back to the Option Block. We are, of course, your bi-weekly choice for all things options related. My name is Mark Longo from the OptionsInsider.com, as well as from the ever-expanding, ever-exciting Options Insider Radio Network. And if you haven't checked it out, listeners, I encourage you to surf on over to your favorite app store and download the old Options Insider Radio Network mobile app on your app store of choice. Of course, Google Play App Store, the iTunes App Store, even the Amazon Kindle Fire App Store. We made a version for you Amazon junkies as well. Check it out. You can, of course, stream instantly all of your favorite episodes of the Option Block and all of your other favorite programs on the old network, as well as download them for offline access on a subway or on a plane, wherever you like to listen to your finer podcast programs. And of course, you can get in touch with us through the app as well. A lot of great stuff there cooking in the old app. Check it out in your app store. All right. Now, joining me on the old all-star panel, as the man said at the top of the show there, we have a crazy cast of characters. Starting off, let's mix it up a little bit. We'll go in order of distance this time and beam in none other than Andrew, the Rock Lobster Giovinazzi from OptionPit.com. Mr. Lobster, welcome back to the program, sir.
Just thrilled as heck to be here. Thrilled. I don't even know what to do. I can't believe I get this invite like this. Freaks me out still.
Every Monday and Thursday, you're sitting there staring at your inbox saying, I hope I get it. I hope I get it today. I hope I made the cut again today.
I hope I made the cut. And I'm thrilled. And of course, Maine is frozen. Actually, we're still in our thaw, but it's sunny. It's sunny and 18 degrees.
Sunny and 18 sounds like perfect hot skating weather to me.
It is, but we had some weird snow. It kind of wrecked the ice a little bit, so it's a little the ponds. You got to go out and you got to do some scraping.
You're never happy up there in Maine. You Mainers,
well, what can
always
you do?
complaining. All right. And moving on to the man beaming in from Casa Jacobson. He is none other than the Viceroy, Alex Jacobson from Options Express by Charles Schwab. Mr. Jacobson, welcome back to the program, sir.
It's good to be here, Mark, and it's curious that we're warmer than Maine today. We may be becoming the vacation capital of the Midwest now.
There you go. If you love your polar vortexes, then by all means, head to Chicago. Run, don't walk. We got you covered.
Sorry, did I just hear the vacation capital of the Midwest?
Yeah, it sounds like we're almost 10 degrees warmer than you.
All I can do is howl at that, although I do love Chicago. It is a fine city.
I guess if you're going to come to the Midwest, you might as well come to Chicago. But right now, maybe you want to hold off a little bit. Still a wee bit chilly out here in the old hinterlands. Speaking of the hinterlands, we'll be joined a little bit later by good old Uncle Mike Tusaw, beaming in from those aforementioned hinterlands, a.k.a. St. Charles, Illinois. But while we wait for him, we're going to dive right on into the trading block.
The trading block.
All right, listeners, those bells mean that it is time once again for the old trading block, the portion of the program where we break down the day that was from an options perspective and from a broad market perspective as well. And it was a relatively quiet day, especially compared to some of the sessions we've seen of late where the S&P and the Dow were rocking more than 1%. Today was essentially unched, fractionally up on the S&P, fractionally down on the Qs, up a little bit more on the old Dow. Not a whole heck of a lot, really kind of an unched day, especially compared to, like I said, some of the recent sessions. Fixed cash getting a little bit of a lift today, going up about 0.3 of a point to 14.2. So since we're talking about VIX cash, let's dive into option pitland, shall we? Mr. Rock Lobster, what really caught your eye in today's session and the last couple of sessions even? Give us that option pit perspective, sir.
Option pit perspective is March VIX future, I would say very expensive relative to cash with, 9 trading days to go for the product. At what I would say is they're pretty steep levels. As far as vol goes, at the money vol didn't do much. It actually kind of came in, but the skew was up a little bit, which is what drove VIX up today. And there's two things, this Crimea thing came back. Since I guess they're going to vote to secede, that might have put a little upward pressure on volatility, and the non-farm payroll number tomorrow. For whatever reason, I think, market players still think it matters. And I think they bid the vol up because they could see, a potential big move. But I don't know what kind of number generates a big move in vol. I guess if it's really, really awful, they're going to stop the taper with one bad employment report. I mean, we already got the ADP report out. You got improving employment today. This has kind of been a seesaw thing this year. So I don't see the volatility is bid for an event that is not happening, except of course for non-farm payroll tomorrow. I'm, a little tiny. I get basically kind of long some strangle type positions in the volatility products. So I'll take one way or the other. Definitely leaning a little short though. So we'll see what happens. I don't see why the vol's this high. Mostly because the market, you remember, Mark, when you're in the SPX and the market just keeps going straight up, it just keeps pulling and pulling and pulling the skew up and up and up. And that path dependency is quaking everybody's gamma.
Yep, it's upside crashes, we used to call them. Yeah, it happened much more than you might think, listeners. You have a lot of short strikes to the upside. It's kind of just the way it works out quite often when you're a market maker, and then you're rallying into a lot of those, and you have to start bidding those up, and especially when you're breaking through a lot of strikes you maybe thought you weren't going to do, or certainly not in a sustained period. So you're right, that vol starts to creep back in, even though from a pure skew perspective, you should be coming off. So happens more frequently than people might think.
Especially when you're up 30% one year and you're continuing to rally the next. And I don't think there's that same supply of willing sellers. So, all these things are contributing to, even while the realized vol is pretty low in the broader market, still, kind of a high single digit. And short term on a 10-day basis, we don't have vol really coming in. We've got a higher S&P 500 and we have higher VIX. So we're not down to that 12 handle in the VIX yet, not even close. So I think there's kind of what I'll call a mechanical squeeze a little bit on the volatility. And, if we don't really see anything of substance, somebody's got to pay that data eventually. And we should start seeing the futures ease off a little bit, but we'll see tomorrow. Tomorrow will be the big day. If we don't get a vol coming in tomorrow, I'll be like, uh-oh, what's going on? So I expect the vol products to take a little nosedive at some point tomorrow.
And Mr. Jacobson, what caught your eye from your viewpoint over there at Casa Jacobson?
So one of the things is in our customer base, they're clearly concerned about what's going on in the Ukraine. And we have seen some VIX call buying. We have seen some Spider and SPX put buying. We've also seen our sort of ongoing premium sellers have pulled in a bit. We're also seeing a lot of play in the energy complex. That continues to be what's lighting up the futures desk and the futures options desk. And again, that's a case where the ETF community doesn't do that good of a job to give you a pure play in the energy complex. So we're seeing a lot of activity in the futures options for people who want a pure risk managed position. Couple earnings kind of lit up the tape today. Costco clearly was a big play. Baidu picked up a lot in the last couple days. And Twitter, as I keep saying, has become the new Lulu. Twitter on our desk is starting to bounce in the volume area of Apple. So it's kind of become the new perennial trading idea.
Yeah, no, this keeps up out there in the energy complex. You guys are going to have to massively restaff that futures desk over there or shift everybody over from the equity risk desk because that's where the risk action is these days.
Yeah. You know what? It's a great option story, though, because 4 or 5 years ago, I don't think anybody really talked seriously about the futures option market. And now as the marketplace has become more electronic and access has become easier and the liquidity provider community has become more option centric. I know when I say that, people always say options have been around for, 4 decades. You're telling me the futures floors didn't have the same expertise in option technology as the option exchanges had? The answer is yeah. A lot of those crowds, a lot of those pits were slow to evolve, and the liquidity wasn't there, and really clever option people with good technology were able to see things. But that's really becoming not a big business. It's becoming a huge business now, and especially the move you had in gas this winter, and now the move you're having in the crude complex. It's so easy to trade those things and to take a risk managed position with a futures option, and customers are seeing it.
I'm glad you mentioned the ETF too, because UNG is probably one of the big players out there from an ETF perspective. We've all slammed the various commodity ETFs here on the show. We won't get into that again, but we talked a lot about how Nat Gas contracts seem to be, for the most part, a lot of premium writing on that 4 handle seemed to do pretty well over the better part of the past year. But UNG was a somewhat similar story. You got to go all the way back to April, really into May of last year before it even broke over the 22 handle again. Had a brief flirtation up there. You can really go back to September, almost October the year before, before it really sustainably traded up there. So premium writers have been pretty active, I'm pretty sure, on the upside up here in UNG as well, and probably suffering the same fate as their brethren out there in the actual Nat Gas futures options, who thought it was probably an easy premium sell and now are starting to reap the whirlwind. Hopefully over the past month, they've made some adjustments. They're not just blasting out upside willy-nilly the way they may have been a few months ago. But still, interesting stuff. Certainly something to keep an eye on here on the old show as Nat Gas continues to move, given everything we're seeing going on in Crimea and the Ukraine over there. Certainly big Nat Gas part of the world. And what goes on from a boots-on-the-ground standpoint, going to keep that market rocking for the foreseeable future. Speaking of rocking, we are joined now by the most rockingest of uncles, none other than Uncle Mike Tusaw from RCM Asset Management. Uncle Mike, welcome to the program, sir.
Always happy to be here, as always. Just liking what gold did today, and another exciting day in the gold world. And for your benefit, Mark, this is just for you only. I created a stupid in gold just for you.
I knew it. I knew you couldn't resist.
So what I did was, we were positioned, we're long the underlying, and then we're also long a protective put at the 126 level. And so to finance that protective put, we've been doing this past week, we did the 122, 127 put spread and closed out of that today. But then I looked at it and I thought, what would Mark Longo do? And instead of closing out the whole spread, I only closed out the short leg of the spread. So now the current position is we're long the underlying, long a 126 put, and also long a 122 put. I am in a stupid just for you.
I love it when the trading decisions are dictated by good content for the option blocks. That should be your primary priority. I also think it's a good strategy to just also ask before every major life decision, what would Mark Longo do? It usually tends to point me, I know at least, in the right direction. I think it'll work.
Now, granted, there was no bid on the 122 puts, but that may have had something to do with it. But nonetheless, I thought of you when I was doing the trade this morning.
It may have played into your decision. I like it. You know me, degenerately long premium all the time. Never saw a stupid I didn't like. So I'm just long stupids up the wazoo across the board. What can go wrong? And I'm very indecisive with my premium too. So why have one strike when you could have five? You know, that's what I always say.
For a zero bid, I couldn't resist.
I love it. I love it. Okay, listeners, it is also that time of the month, or close to it, near the beginning of the month, where we have a lot of numbers pouring in from throughout the industry. We'd like to take a check in, see how things are doing. First up, from our friends over there at the OCC, the Options Clearing Corp, they announced that in February, total options contracts traded was up about 7.5% compared to this time last year. A total of 344,900,000 contracts going up in February. The ADV was 18.15 million. It's up about 7.5% as well from this time last year in February. Year-to-date options volume so far, it's up about 734 million contracts. Again, up about 7.75% compared to this time last year. Breaking it down a little bit, looking at equity options, Feb volume was about 307 million contracts, up about 5% compared to this time last year. ADV, 16.17 or so million contracts, up about 5% as well. And year-to-date equity options volume is almost 659 million contracts, up about 6.25% from this time last year. So from an overall options perspective, not doing bad. Of course, that doesn't really surprise given the fact that February was a pretty rocking month compared to last year. Certainly, we saw multiple 1% moves in the S&P, translating into some implied vol, translating into some options action. Alex was just talking about the futures and the futures options, so I thought I would rope them into the conversation too. Looking over there at CME, they announced that their February volume was up about 2% compared to February of last year, up 8% from January, again showing just how much of a rockin' month February was. Total volume for them in February is 266 million contracts. What's interesting for this show, 86% of that volume trading electronically. So that kind of gets back to that perception a lot of people still have about futures and futures options being these predominantly open outcry, pitch traded kind of things. You got to sit on the phone and work your orders, and it's very laborious for an at-home retail type customer to do. 86% of those orders going up electronically over there at CME. So that's interesting. If you want to break it down even further, we can go into the categories. Interest rates up about 6% in February last year. Euro-dollar options up about 92% from February of last year. Big boom out in Eurodollar, given everything that's going on overseas and, of course, with the Fed and everything else. Making that complex come back to life compared to last year, as reflected in that almost 100% increase out there. Treasury options up about 15% from the same period last year. Overall equity index volume up about 5% from the same time last year. FX down about 28% from Feb of last year. So last year, at least in February, was a little bit more active time from a currency perspective. Not surprising. Energy up about 4%. Really, really solid boom. And Nat Gas, no surprise, up about nearly 30% from this time last year, and 75% overall growth in power contracts. That probably reflects more of the nascent volume of the power complex going up there on the CME. Ag stuff, we're always talking about ags and corn and things like that too. Ags averaging 1.4 million contracts a day, up 7% from this time last year. And here's one for you, Uncle Mike. Kind of interesting. Metals kind of bringing up the rear in February, only averaging 351,000 contracts a day, actually down 20% from February of last year. So some interesting numbers going on across the board. Strong from an options perspective and overall strong from a total futures and options perspective as well, even if a few laggards like the metals really kind of bringing up the rear.
The other thing that I think is that a lot of my gold bug brethren, I think, are going over to natural gas right now. Natural gas is obviously something that's moving a lot more. And I think for that purpose, I think a lot of the shininess has lost its attraction to the slipperiness of oil and the I don't have anything for natural gas, just natural gas.
Yeah, it's a slippery slope once you start going down that Nat Gas realm. But it's interesting, you're right. And that would probably speak a lot to the flow that goes after those things, even retail being attracted by the comparatively higher levels of volume and volatility out in a product like Nat Gas these days. And I guess starting to siphon off over there. Alex, do you think that anecdotally you're kind of seeing that same thing as well? Obviously, Nat Gas lighting up the tape over there at OX. Do you think a lot of that volume is being siphoned off from other products like traditionally the metals and other areas?
I think it's two different baskets of money. I think the GLD does such a good job because it holds the physical that it doesn't have the problem a lot of the other ETFs have where it really doesn't track well. That GLD has become kind of the perennial favorite. So people don't have to go to the futures and futures options market. In Nat Gas, if you really want to track, you got to go to the futures or futures options market, and you can see that in the volume. Same thing in most of the energy complex. The ETFs just don't do a good job, and gold and silver are the exception because they hold the physical. So they're a real track, and it also talks a little bit about getting a robust order flow and getting good liquidity in the ETF trading and the options trading. The CME and the ICE still both have a big job to do, but it's clear that the message is the more you automate, the more your volume goes up. I'm a broken record about they need to automate the option on the big S&P, and for the life of me, I don't understand why they do that other than exchange politics. But I can tell you at OX, if we had that product automated, you would do big numbers. I mean, you'd start to see the numbers you see in the SPX complex now.
Yeah, there's still a lot of floor inertia for the S&P stuff. Look at the SPX pit at the CBOE. Look at the S&P futures and options pits over there at the CME. Still a lot of people with a vested interest in keeping those alive for a variety of reasons we won't get into here. But still, interesting stuff and something certainly to keep an eye on. And I think we'll start rotating those numbers into the overall rundown here on the show more often as futures and futures options become a bigger part of the retail trading story. All right, and now we're going to keep on rolling right on into our next segment, the Odd Block.
It's time to break down the most interesting, unusual, and downright questionable options activity that's been identified by theoptionsinsider.com. It's time for the Odd Block.
All right, everybody, that funky tune means it is time once again for the old Odd Block, the portion of the show where we break down the weird, the bizarre, the interesting, the unusual options activity that's lighting up the old tape. Going to kick things off with an Odd Block special here. This is the James River Coal Company, ticker symbol JRCC, closing today at a whopping 74 cents. Not even a buck, listeners. And this one, this is the name that does about 1,700 contracts a day. Granted, the stock itself is an option, so it's amazing they do any at all. And yet they did about over 3,000 today. The lion's share of that, 2,786, coming in looks like a mega blast on the June half. That's 50 cent. Put strike, where we saw a big block in the morning of 1,703 going up, where someone blasted out these puts for about 20 cents. Again, there were more people piling in after the fact to the tune of about another 1,000 or so. So for a total, like I said, of 2,786 puts. The volume, the open interest on this strike is only about 650 contracts. So it is opening paper. Interesting stuff. You don't see these types of plays and these little names too often, which is kind of interesting. This guy essentially writing these puts for nearly half the volume, half the price of the stock at that point if it just does go down to that level. So interesting stuff. I think someone just drawing a line here. Senior Rock Lobster saying this far, half and no further.
Yes, this was Trader Gaddafi. Maybe it's one of his sons. I think Momar's gone, right? So somebody is drawing a line in the sand, I think, at 30 cents. It will not go up 30 cents. Plus, the company, I believe, is trying to put themselves up for sell some assets. It's one of the classic. It's a coal company that I think the book value is probably 2 or 3 times what the stock is easy. So they're like, hey, we need help, but probably God knows what how much the equity is worth that they could actually sell some assets. But it actually doesn't look like a bad way to make 20 cents to me, but maybe I'm crazy. I think it's the right way to sell a put. I'm not going to give away what I want to talk about, that we're going to do on Saturday, but I think that is, in the coal, with where coal is right now, I don't think those plays look all that bad. I got to be honest with you.
There you go. Andrew Giovinazzi, the Rock Lobster, loves blasting out puts in names that could be bankrupt at any moment, sir.
Exactly.
All right. Moving on over to another, I'm trying to remember if we've done this one before. I don't think we have. This is CWH. That is the CommonWealth REIT, closing today pretty much unched at $27.67. This is the name that does about 2,000 contracts a day, doing 9,000 today. So putting up some paper today in good old CWH, and the lion's share of that yet again coming in one pretty sizable trade going up on the April 22 half strike on the put side. We saw someone coming in and moving. It actually all went up in one block. It hasn't changed since the rest of the day. It was 5,147 contracts here. Yeah, it looks like this was a sale for about 15 cents. Given the fact that there's some size open interest on this strike, about 1,300 contracts or so. 13,000 contracts. This is probably a closing sale of some longer puts. And of course, there also was some action on the April 25 put strike, where we saw about 2,600 of those going up today as well. Perhaps a wee bit of a 1x2 senior Rock Lobster here in CommonWealth REIT.
It was really weird. This stock is trading at a 52-week high. It feels like it's a roll up of protective puts. Because they're long the put, and it's the thing is, if you're short the April 22 puts for 15 cents, would you close those for 15 and sell the quarters for 45? Doesn't make any sense to me. So I would think if you're along the 22 puts, you're like, well, I'm not getting any protection, so I'm going to roll up to the April quarter puts and protect my gain. So I thought it was like kind of a long put closing, sort of a long put, long stock strategy. It's still a little weird to me, but it's a love your broker trade, it feels like, to some degree.
That's why it's in the odd block. When they're weird, they come calling to us.
They do. There's the siren song of the weird trade. So that's what it kind of looked like to me. But hey, it's a pretty low volatility stock. I can't see liquidity providers paying 15 cents for those puts, but possible. So that's what it felt like anyway. I think they bought a cheapy little put spread there from the liquidity provider side.
Speaking of cheapy, we're moving back to the cheap seats here for our next name on the old odd block. This is MeetMe Inc., one of my favorites, I know. Meet, ticker symbol MEET, not MEAT. They closed today $3.22. Up, though, about 22 cents. So they were trading $3 not too long ago. This is the name that does usually about 300 contracts a day, doing about 5,000 today. Not surprising given the fact that they moved nearly 8% on the old day. And what we saw today was a lot of people piling in to the August 1s.
August 1s. I just feel the air leave the room.
Yeah.
The thing that caught my eye was there was a lot of open interest on the 1 and 2 strike that is now in the money. So what I'm looking at is, this one, first off, the August 2s, it was a straight sell of 500 contracts, right? So think about it this way. You're selling the August 2s for 28 cents over parity mark. What are you making there? So I guess it's a yield play. Not a bad yield play, I guess. It would be a yield on $2. So you're making 28 cents on $2 through August. So that's better than probably 10% on your money. That was what caught my eye first. It kind of looked like a clever yield play on the August 2s. Then what I saw the paper on the August 1s was there's high open interest and there's a lot of call buying. So I think maybe there was some kind of possible, writing going on, and they're covering their short one calls. So, but on balance, it looked like, buying paper. So kind of a strange confluence of paper, but there was speculation on the May 6 line, the May 5 line, the August 6 line, August 5 line. So there's definitely there's volatility out there. There's options trading, but this particular trade, the August 2 line, I just think somebody did a buy right for the yield. They're like, I'll take my 10% to August and be totally happy with that. So, but there was, I believe, some short covering on the ones.
Gotta love the short coverings on the one strike. Gotta love it.
They buy the stock at 50 cents and sold a month? I guess so.
I'm long from 8 cents. I'll write that one strike all day long. All right. That's why we love them here in the Odd Block. Rolling back up to a name with a little bit more meat on the old bones. We're going to close it out here with KRE. This is the Spider KBW Regional Banking ETF, closing today $40.73, up about a quarter or so on the day. This is the name that does, about 4,000 to 5,000 contracts a day, doing a whopping 30,000 today. And I said rolls before. I meant it quite literally here. We saw a pretty sized roll. Not down and out, not out in months or anything like that. Pretty much just rolling up one handle. We saw someone coming in, selling out about 11,000 of the June 40s, and then picking up about 11,000 of the June 41 calls. Given the fact that there are about 18,000 open on that June 40 strike, it looks like a pretty clear roll with perhaps some more volume left to go in upcoming sessions. So, Senior Andrew, a one-handle roll. You don't see these very often. This is another love your broker trade. What's going on today?
I was, because it didn't go up Mark's spread, but they all went up on the SIBO, and they all went up within, moments of each other. So it doesn't go up Mark's spread, but at 958, 1,000 trade of the 40s, and at 958, 1,000 trade of the 41s. You're like, what's going on there? So I guess they made, my guess, what it looked like is they bought the 40s for not a lot of money. There was a good run in the KRE, probably after, it was a good scoop, it looks like. And they're taking their money on the 40s, I guess, and just playing with house money on the 41s. That's the only thing I could really think of.
Yeah, you got to love this one, pitching this one to your risk manager. Yeah, I made a ton on these 40s. Let's take someone off the table, and then let's just roll up to the 41s. Let's just do it.
I mean, if you go back in time, like those 40s were probably trading for maybe a quarter or something when the stock was trading 37, when the KBW might have been, because it was just recently kind of in the ash can. As recently as late January, it's trading 37 and change. So, you could have picked those up for not a lot of money, and, you're flipping them out now. But, why roll up to the same month, though? That's kind of goofy to me. But so, again, volume trading, same time, same exchange, within microseconds of each other, not marked spread. So, I don't know.
Yeah, that one's weird, not just for the size, but for the strategy there. You're right. There's a lot of different ways you could adjust that. We talked about this on the show in the past. Maybe you take some of them off to see the rest of it. You're playing with house money. You could leg into other spreads. You're right, though. You don't usually roll up one handle, and usually not to the same expiration month. Usually you roll out a little bit and give yourself a little bit more time to work. But apparently that's not the case. This guy wants those June 41s. So there we go, sir. That is going to do it for us here on the old Odd Block. And now we're going to keep on rolling right on into Alex's favorite segment, the Xpress Block.
The Xpress Block, brought to you by Options Express. Options Express lets you trade where and when you want for every level of trading. From advanced charting, free daily trading ideas, and free educational resources, Options Express is the online broker for all traders. Best of all, Options Express allows you to trade stocks, options, and futures all in a single account on powerful yet easy-to-use trading platforms, including mobile devices. Visit optionsexpress.com/OXradio for your free account. Options Express is a member of FINRA, SIPC, and NFA.
All right, everybody, welcome to the Xpress Block. This is where we get our behind-the-scenes tour into the land known as Options Express by Charles Schwab. And sometimes we get that tour remotely via Casa Jacobson, and we're going to do that today. So, Senior Viceroy, give us our behind-the-scenes glimpse into the land known as OX by Charles Schwab.
So when I pinged John Grigas, who runs our trading desk today, he asked me to talk about a topic, and that's the upcoming dividend of the Qs. And apparently this has created a lot of confusion amongst people who trade the Qs and people who trade the Q options. And I think every time either the spider or the Q goes X, there's a clear misunderstanding. And Grigas empowered me to not so much clear up the misunderstanding, but to tell investors that if you've got Q positions, Q covered rights, be aware that it's going X March 21st. And because I can't give investment advice, I can't focus on specific strikes. But if you're an OX customer and you have a question, you've got a covered right position on, especially if you've got the weeklies on, call the trading desk and we'll give you a sense of what the X dividend could mean. So please be aware of that. If you're not an OX customer or you're not a Schwab customer, talk to your trading desk if you've got a position on so you get a sense of what the X dividend date will mean so you don't have an unhappy surprise when you come in the next morning. In terms of what else John said was active today, we talked a little bit about both Baidu and Costco. SodaStream picked up at the end of the day. Apparently a story hit the tape of a hedge fund buying into SodaStream. And that's kind of the Pepsi speculation for SodaStream. Staples was active all day. I know we're going to talk about that a little more in a bit. But it was kind of a quiet day overall with kind of pockets of activity. And the big activity, as we talked about, was in the energy complex.
You know, it's amazing how these dividends and these big index products still creep up on people and surprise them every time. You know, it happens in SPY, happening again now in Qs. It is kind of funny. People tend to lose track. They think it's just like another stock in their portfolio. They forget these other components that go into it, like the dividends. So good advice there, Mr. Viceroy. And now we're going to keep on rolling right on into our next segment, the mail block.
Now it's time to empty the mailbag and see what our listeners have to say. It's the mail block.
All right, everybody, welcome to the mail block. No offense to the Viceroy or Andrew or Mike or pretty much anyone else who's ever been on the show, but this is really my favorite segment because it gives you guys a chance to join us here on the old All-Star panel, vent your feelings, your frustrations, ask your questions, give us your comments, all that fun stuff. If you'd like to be featured in an upcoming mail block segment, you know how to do it. Surf on over to theoptionsinsider.com. Leave us a question or a comment on the old show notes of this program, and we'll be sure to route it here to the option block. You can also find us on email, questions@theoptionsinsider.com. Just be sure to put question for the option block in the subject line. A lot of you guys love to use Twitter and Facebook. Easy to find us there as well. Twitter.com/options, Facebook.com/theoptionsinsider. A lot of great ways for you guys to stay in touch with the show, including the new mobile app, a great contact suite in there, has all that stuff, email, even voice. You can leave us the voicemail, all kinds of fun stuff in the contact suite through the mobile app. So a lot of great ways to make your questions heard on the panel, just like your fellow listeners, starting off with Mr. J. Charles. He writes, my question for the All-Star panel is about analytics platforms. I've heard you guys mention a variety of different suites like LiveVol. I pretty much just use my broker's tools and they work fine for me. I can pull up the options chains, click on the strikes and options I want to trade, click on the option to enter a trade and all that stuff. I can also pull up skews and research. It really does the job for me. What is it that these other platforms offer you that would be worth me paying $200 plus a month in extra fees? Sorry, but I'm not an OX customer, although the show is pulling me in that direction. Well, that's nice to hear, Mr. Charles. He goes on to write, hope that doesn't hurt my chances of being featured on the program. Nonsense. We don't just feature OX questions here. On the old program, we answer questions from all of you guys out there. We're egalitarian here on the old mail block. And this is a good question, actually, and we get variations on this a lot. We've talked about different platforms. I think I've mentioned, I'm sure Andrew and others have mentioned LiveVol, like you mentioned here in the article or in your question in the past. And we like those platforms, but starting off, if you're happy with what you're using, if it does the job for you, if it allows you to access your trades relatively quickly, to populate your spread tickets, to find new trades very easily, then there's nothing that says you have to use these other platforms. I mean, the brokerage tools. I mean, Alex is always talking about what they're doing here at OX and how much time and resources they're spending to develop that platform. They're making a lot of great stuff available to you guys for free. So don't let me be the evangelist for buying additional platforms. You guys really should investigate all the tools that your brokers offer you, because that's the best way to go, because it's free. Who wants to pay extra fees if you don't have to? That said, we do use a lot of other platforms here at Insider for a variety of reasons that may not fall into your use case here. Mr. Charles, for example, we're always highlighting and analyzing unusual activity. We like to be able to call it up and analyze it on the fly. That's a little bit more difficult to do in a particular brokerage platform. And for me, I like the ease of access of having one thing open throughout the day that is separate from our various brokerage accounts that I can kind of jump into very quickly, and it's kind of just dedicated to options. So I can pull up my chains really quickly. I have my lists right there. I use LiveVol for a lot of that because it is kind of a dedicated options platform. When you get into the brokers, by default, they have to offer you a lot of other things because they have other clients trading other things. They have stocks, they have futures, they have research, they have all kinds of other tabs and things that are great for functionality for the client. But for us, if you want to keep tabs on a few things throughout the day, check time and sales, check real-time markets, that sort of thing, something like LiveVol, for us, that fits our use case. It's very valuable. We like to have that open and be able to dive in and out of it really quick without some of the other things you have to deal with when you're jumping in and out of a brokerage platform every day. So for us, that fits our use case. But for you, that may not be your use case. So don't be ashamed of that. Don't be ashamed that you're not paying extra money for analytics out there. Now, Mr. Andrew, I'm sure you get this question a lot with your clients. What do you counsel them about the buy or do not buy from the analytics perspective? He says. I gave you a nice long answer to give you time to think, and I get a
I like the LiveVol suite just because the volatility analytics are more geared toward how I'm used to looking at them, kind of like from more of a market maker, trying to look at skew differential and things like that. So from anybody I say that's a vol trader, it's much easier to kind of set things up in that direction, which I believe kind of what they're kind of going after. So I like that, and there's several other platforms that look pretty good. I have an OX platform for part of an IRA, so it works pretty good for me. But I'm not using a lot of analytics on that per se because I already know what I want to do. I'm fishing around in other places for stuff, so I use it just to get my order executed. So it's been working perfectly fine for that. But ultimately, what are you using your platform to do? And I think you made a good point about that. So I like as quality of volatility data as I can find in general. And I like to be able to see. I also use my little 3D product for helping me figure out what's going on when I want to generate ideas or I want to look at skew. So again, that's how I look at the market, probably not the same way everybody else does. So, I wouldn't mind having a Bloomberg terminal as well kicking around, but that's the way it is.
You draw the line at the Bloomberg terminal. Understandably so. They are ridiculously overpriced for what you get these days. But that's a conversation.
It's a nice mortgage.
Yes, exactly. This show brought to you by Bloomberg, by the way. So there you go.
Mark, I'd like to chime in if I could. So as controversial as this is going to sound, I think the brokerage platforms give you 70 or 80% of what you could need. If you're trading a lot of money and you're real active during the day, and as Andrew pointed out, you're looking at skew, you're trying to identify ideas, you want to find a specific skew and butterfly around it, I think the brokerage platforms, as I say, give you 80 to 90% of what you want. Is LiveVol worth $2,400 a year? Are some of these platforms worth $124 a year? If you're trading a big portfolio and you're getting granular down to the kind of things that Andrew talks about what he looks for, I'm going to give you a strange answer. Yes, they are worth it. Because the brokerage platforms, competition in the e-commerce brokerage community has been quality of execution and platform. And I'll tell you a little behind-the-scenes secret for most of us in the community. Some of what we provide to you, we buy from vendors. Some of it we do ourselves, and some of it we buy from vendors. Man, if the questioner's got a couple $100,000 option portfolio and he trades a lot of ratio spreads and looks for anomalies, then I think the $2,400 a year is worth the money. If he's got a $25,000 IRA and he's selling covered calls against it, then he doesn't need it. So it depends on who you are. You know, do I want to drive the car or do I want to get out there and tune the fuel injection? And the answer, it depends on what kind of trader you are. And some of these add-ons, $2,000, $3,000 a year, extra technology may be worth it for you. And the thing I would encourage you to do is most of these platforms, most of these tools have free test drives. See if it helps your style.
Well said, as always, Mr. Viceroy, and you're right, he doesn't really mention his trading style or his account size, so that would obviously give us more specifics into his unique situation. But yeah, if it works for him and he has the account size, then certainly he's not going to sweat that $2,400 a year, then by all means, dive in, Senior Charles. All right, next up we have a comment here from Brian Nick, and he writes, just pulled up Option Block on your app. Hundreds of episodes waiting for me. That's serious streaming goodness. Commute is covered now. Thanks. So there we go. Brian, we're glad we could cover your commute. I joked about that on our 300th episode. We do have indeed many, many hundreds of episodes out there. Over 300 now, to be precise. We could cover you for pretty much a full month of 24/7 listening if you are so inclined. So glad we could make your commute a little bit better. And again, that's a great use case for the app. You can pull it up and get pretty much access to the full archives of a show right there, touch of a button. So if you want to go back and check out something we talked about a year or two ago, maybe an odd block name we talked about, an educational segment, whatever the case may be, it's all right there at your fingertips in the old app. Next up, this one's straight for you, Mr. Andrew, so put your listening ears on. This is the question from a user goes by the handle Avent. I'm not sure how to pronounce that. And he writes, I bought 50 Zynga March 5 calls for 17 cents last month. They're sitting around 60 cents right now. Well, first off, congratulations. He goes on to write, what should I do? Sell half and let the rest ride, roll to April 6 calls for 28 cents, take the stock, and then write covered calls against it. I'm assuming he means let the calls expire, buy the stock, and then write more calls. And he also writes, I'm still mildly bullish on Zynga, but worried about a near-term correction. Well, a lot of different ways to take that question. Mr. Andrew, I could see you really just champing away over there. You want to answer this one, so do you have pride of place, sir? Walk us through what you think Mr. Avent should do in your favorite name, Zynga.
Well, I think I definitely would take the money he's made on the March 5 calls. One is because you're running out of time. Because there's nothing worse than being right, but then not getting your money. So I would close the March 5 calls, relatively soon, because you only got 2 weeks left. The next thing is I think Zynga, like most of the plays I've done in Zynga, have been of 3-month duration. I think it is a recovery story, which normally does not bode super well to near-term out-of-the-money call buying. So probably roll to June and look for some maybe at-the-money calls in June or even further out. I would be careful just buying out-of-the-money calls. The volatility is extremely cheap in Zynga right now. So, it still makes sense to buy calls just at the money or maybe one strike out. But I would give yourself a little bit more time, take some money off the table in doing so. But again, if you're going to keep buying calls, I think time is still your friend in this stock, as long as the story they continue to kind of do this basically repair story. So take your money, move your duration out a little farther, and on you go.
Never went broke taking your profits off the table. So you wouldn't leg into maybe a risk reversal here.
Well, the problem is what do you sell? I mean, you could sell an April 5 put for 18 cents. The April 6.5, you might see some money out of that. But the thing is, for a risk reversal, I mean, you really got to go to June. You could sell, realistically, you could sell like the June 4.5 puts and buy the June 7 calls for even. But normally with a risk reversal, I would just sell some June 4.5 puts. And if you want to take the stock, cool. And if you actually start to get a little rally, then maybe you buy some calls against your puts. That's how I would do that in June. But it's just there is more upside skew in the calls than there is in the puts. Zinga.
Yeah.
And there's not a lot of volatility anywhere. I think, in general, just buying options is still the cheapest way. So the risk reversal, I would have to go all the way out to June. I'd be more apt to buy something like a June 5.5 call and just, you're sitting on it for a couple of months and letting it continue to rise. But I think you need 3-month duration, really.
All right, so we're running low on time, so I'll get to this next one really quickly for Uncle Mike, because I know he's very excited about it. This question comes in from Mr. Philip Gregory out of Dallas. He writes, I like your advice about writing puts to get long stock, but I keep hearing people warning me about gap risk. What exactly are they talking about? Is this something unique to options, or are limit stock orders also subject to gap risk? Senior Uncle Mike Tusaw, take it away, sir. Walk our friend Mr. Gregory here through gap risk.
Well, let's compare the two. Let's say XYZ stock's trading at 55 and you want to own it at 50. One thing that you can do is put in a good till canceled order to buy the stock at 50, just a good old-fashioned limit order. And what that's going to do is the order is going to be continued going onward and onward. And then where the gap risk wouldn't affect you overnight is, let's say that all of a sudden the stock went down to $42 on Tuesday night. You can then go into your account, because it's after market hours, and you can cancel that order. Now, let's say that you short a put, you short the 50 put going into it, and by shorting the 50 put, then all of a sudden, and you put that on right away because you're fine owning that stock at 50 anyway, let's say, if you have a gap down to $42 on the Tuesday night, the next morning you still have the obligation to buy that stock at 50. So that's where the gap risk comes into play. But one thing to understand on is that goes two ways. Let's say that you have a gap up to $62. Well, if you just have the stock limit order, you get nothing. Whereas if you're short the put, the value of your put goes down to, let's say, a nickel the next day. You can buy your way out of the put, and you can make some money on it. So there's pros and cons to doing each of them. Typically, if I'm in a position to where I want to own the stock anyway, I'm fine taking on the gap risk because I'm happy to own the stock at that level anyway. It all depends on what you're trying to do.
Indeed, just a limit order by another name, and you actually get paid for it, so there are worse things in the world. All right, and that is all the time we have for the mail block segments, also all the time we have for this episode of the option block. But before we go, let me check in really quickly each of my cohorts, my partners in crime, see what they have cooking in their respective necks of the woods, starting off with you, Mr. Giovinazzi, a.k.a. the Rock Lobster. What's cooking in the land of the pit?
On March 8th, we will be doing Selling Puts in an Ugly Market with Mark Sebastian. Still time to sign up. You get all kinds of deals if you sign up for one of our webinars to grab some of our other educational services, which people like. We grow every year. But the key is we'll spend a little time identifying what really that ugly market looks like. And sometimes it's not always what it appears to be. So please, we started, I believe, 10 a.m. Surf on over to Option Pit /events and sign up, and hopefully we'll put some learning on you.
I like it. Put some learning on you. Speaking of putting learning on people, Uncle Mike, what's coming up on the land of the RCM webinar train?
We got a bunch of things coming up. We're going to have another webinar this month on weekly options. We're going to have a webinar on several things. We'll have them up next week at some point. Stay tuned.
All right, and last but not least, Mr. Viceroy, take us home. What is coming up in the land of OX by Charles Schwab Edumacation?
This Saturday, live event in Crystal City outside of D.C. Join Jim Ruzan, former Group 1 market maker, doing about a 3/4 of a day event. If you can't make it out to Crystal City, we do it as a virtual event on the site, optionsexpress.com. And you can participate as if you were there. You could be in your slippers with your mug of hot chocolate. Tuesday, I'll just showcase a couple of events. There is a full webinar schedule. Tuesday, March 11th, Jim Wyckoff doing his monthly futures outlook. Jim writes the well-known Wyckoff letter. And then in the afternoon, Nina, our director of education, is going to do risk gauges looking at Vega and what it tells you and what it means. So navigate over to optionsexpress.com. There is a full schedule of events. Everything's free, and it's all out there available.
All right, that is going to do it for this episode of the Option Block. On behalf of Uncle Mike and the Viceroy and the Rock Lobster and, of course, myself, I want to thank all of you out there in the listening audience for downloading and streaming and subscribing to this program and, of course, for writing in such great questions. Keep it up, and we'll see you next time right here on the Option Block.
Become a part of the Option Block. Just visit www.theoptionsinsider.com/forum to post a question for the hosts. You can also submit questions to twitter.com/optionblock or leave a voicemail at 312-544-9356. Make it interesting and your question just might make it on the air. The Options Block is property of the Options Insider Incorporated. All rights reserved.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.